Hello everyone, this is Nitish and we have started an initiative called Plums series which is Prelims Level Up MCQ series. Here we discuss 5 MCQs daily and this will help you in your UPSC preparation. Today is episode number 39 and I am dealing with economics MCQs. Before starting this class, I would like you to please subscribe the channel and also like and comment on videos. These contents are free of cost, so for test series and foundation videos, you can contact to Vysh sir on WhatsApp 7200 681 675. So let's begin. Today's MCQ number 1 is which of the following are the components of statutory liquidity ratio? Cash, gold, treasury bills, dated security issued under market stabilization scheme, state development loans. So the options are 2, 3 and 4 only, 3 and 4 only, 1, 2 and 5 only, 1, 2, 3, 4 and 5 only, which means all of the above. So try to answer this question and write it in the comment section. I will give you 10 seconds. So the answer will be option number D, which means that all of the above. So before knowing the components of SLR, which that is statutory liquidity ratio, we should know what is statutory liquidity ratio. It is a minimum percentage of deposit that the commercial bank has to maintain in the form of liquid cash, gold or other securities. That is, the commercial bank have to maintain a minimum percentage of deposit in the form of liquid cash, gold and other securities. That is called a statutory liquidity ratio, in short SLR. It is basically the reserve requirement that banks are expected to keep before offering credit to customers. So now let's look at the components of SLR, that is cash, gold and incumbent securities, treasury bills of government of India, dated security issued under market borrowing program and market stabilization scheme. So many of you think that is what is market borrowing program and market stabilization scheme. So for knowing this concept, you can watch my economics series already in the Vysh IAS YouTube channel. So component number 5 is state development loans of the state government issued from time to time under market borrowing program and any other instrument as may be notified by Reserve Bank of India. So all these components are already mentioned in the question, that is statement number 1, 2, 3, 4, 5. That's why all the statement or all the components are true. Now move on to MCQ number 2. With reference to marginal standing facility, consider the following statement. It is an interbank borrowing facility for bank in an emergency situation. Under MSF, bank borrow funds from RBI at a rate higher than repo rate. Bank can avail funds under MSF using statutory liquidity ratio securities. So you have to identify the correct statement. Options are 1 and 2 only, 2 and 3 only, 1 and 3 only, and all of the above. I will give you 10 seconds. Try to answer this question and write it in the comment section. So its answer will be option number B. That is statement number 2 and 3 are correct and statement number 1 is incorrect. In order to answer this question, you should be aware about what is marginal standing facility. And these concepts I already taught you in economics series, whose playlist is already mentioned in the Vysh IAS YouTube channel. So please watch those series so that you can able to answer this basic question. So now let's look at the explanation. Statement number 1 is incorrect. So we know what is the reason behind it. Marginal standing facility is a window for banks to borrow from Reserve Bank of India, not within banks. That is not interbank. Okay, in an emergency situation. That's why the statement number 1 is wrong, because here it is mentioned interbank, which means that one commercial bank borrow from other commercial bank. But here the statement is wrong because the bank will borrow from Reserve Bank of India in an emergency situation, not within the bank. The MSF would be the last resort for bank once they exhaust all borrowing options, including liquidity adjustment facility. Liquidity adjustment facility is a facility extended by RBI to the scheduled commercial bank to aid banks in adjusting the day-to-day mismatches in liquidity. Now, let's look at the statement number 2, which is correct. Under MSF, bank borrows from RBI by pledging government securities at a rate higher than repo rate. Under LAF, repo rate is the rate at which the RBI lends money to the commercial bank against the securities in the event of any shortfall of funds. Under MSF, banks can borrow fund up to 1% of their net demand and time liabilities. Statement number 3 is also correct because while borrowing money under MSF, banks are permitted to make the use of SLR securities, that is statutory liquidity securities, which is otherwise not allowed in the case of repo rate. That's why the statement number 3 is also true, statement number 2 is also true, but statement number 1 is false. Now, move on to MCQ number 3. Consider the following statement with respect to money supply. Credit and loan are not taken into account while measuring money supply in an economy. An increase in supply of money can lower the interest rates and generate investment. Now you have to identify the correct statement. One only, two only, both 1 and 2, and neither 1 nor 2. So try to identify the correct statements and write your answer in the comment section. I will give you 10 seconds. So the answer will be option number B, which means that the statement number 2 is correct and statement number 1 is incorrect. Now let's look at the explanation. So before going into the statement, you should know the basic about the money supply. That is, the total stock of money circulating in an economy is the money supply. The circulating money involves the currency, printed notes, money in deposit accounts and in the form of other liquid asset, which means that the currency, printed notes are circulating money. Now we will move into the statements. That the statement number 1 is incorrect because different measures of money supply take into account non-cash items like credit and loan as well. The money supply roughly includes both cash and deposit that can be used almost as easy as cash. That is the statement number 1. That is, credit and loans are not taken into account while measuring money supply in an economy, but the credit and loans are taken into account, as I already explained you in the answer. Statement number 2 is correct because if there is an increase in supply of money, the interest rate is likely to decrease, which in turn generates more investment and puts more money in the hands of consumer, thereby stimulating spending. So the statement number 2 is correct. An increase in the supply of money can lower the interest rate and generate investment. Now move on to MCQ number 4. In India, the central bank functions as the lender of last resort, usually referred to which of the following? This question is basically taken from previous year question, which means PYQ. So try to focus on it, and the statements are lending to trade and industry bodies when they fail to borrow from other sources, providing liquidity to the bank having a temporary crisis, lending to governments to finance budgetary deficit. Now the options are 1 and 2, 2 only, 2 and 3, 3 only. I will give you 10 seconds. Try to answer this question. Here you have to find why the central bank function as a lender of last resort. What does it mean? So you have to, on the basis of that, you have to find the statements. So the answer will be option number B, that is 2 only. Now let's look at the explanation. A lender of last resort in an institution usually A country's central bank that offer loans to bank and other eligible institutions that are experiencing financial difficulty or are considered highly risky or near collapse. So, you understand what is lender of last resort. The lender of last resort functions to protect individuals who have deposited funds or to prevent customers from withdrawing out of panic from banks with temporary limited liquidity. Commercial banks usually try not to borrow from the lenders of last resort because such action indicates that the bank is experiencing a financial crisis. So, on the basis of the explanation, we can say that only statement number 2 is correct because statement number 1 is incorrect and statement number 3 is also incorrect because here we can see the statement that lending to trade and industry bodies when failed to borrow from other sources, which is not mentioned in the explanation. And in the statement number 3, lending to government to finance budgetary deficit, it is also not mentioned in the explanation. That's why the statement number 1 and statement number 3 is incorrect and statement number 2 is true. Now, the last MCQ of this video, MCQ number 5. With reference to prompt corrective action framework, consider the following statement. The framework aims to check the problem of non-performing assets in the Indian banking sector. It can be initiated against small finance bank and regional rural banks. The mandatory restrictions under PCA framework includes curbs on lending and deposits. Which of the following given statement above is or are correct, which means that you have to find the correct statements. Options are 1 only, 1 and 2 only, 2 and 3 only, and 1 and 3 only. So try to answer these questions in 10 seconds and write it in the comment section. So the answer will be A, that is 1 only, which means that statement 1 is correct and the other 2 statements are incorrect. Now let's look at the explanation. The Reserve Bank of India has unveiled a revised PCA framework for scheduled commercial bank and changes will be effective from 1st January 2022. Now look at the statement number 1. Statement number 1 is correct because prompt corrective action framework is a structured early intervention mechanism for banks that become undercapitalized due to poor asset quality or vulnerable due to loss of profitability. It aims to check the problem of NPA, that is non-performing asset, in the Indian banking sector, which is the statement number 1. That is, the framework aims to check the problem of NPA in the Indian banking sector. And the explanation we have already seen. Now, statement number 2 is incorrect. Prompt corrective action framework could be applied to all scheduled commercial bank. In the latest revised guideline, small finance bank, payment bank, regional rural banks have been excluded, not included, have been excluded from the list of lenders where prompt corrective action can be initiated. That's why the statement number 2 is incorrect because it is mentioned it can be initiated against small finance bank and regional rural bank, and I already explained you that small finance bank and regional rural banks are excluded from it. Statement number 3 is incorrect. The restrictions on the banks when PCA is invoked, mandatory restrictions and discretionary restrictions, which means that the 2 types of restrictions are imposed or invoked under PCA. Under mandatory restrictions, it includes restrictions on dividend, restrictions on branch expansion, restrictions on management compensation, among others. And in case of discretionary restrictions, it includes curbs on lending and deposit, recommending the bank owner to bring new management and board, among others. That's why the statement number 3 is incorrect because it is mentioned here that the mandatory restrictions under PCA framework includes curbs on lending and deposits. That's why the answer is A, which is 1 only. I hope you like this video. So the next episode will be tomorrow. So please subscribe and stay tuned. Thank you.